provisions. All right. So here's the first, because we were just setting up the context for the policy provisions for life insurance. So the first of the policy provisions for life insurance is the entire contract provision. I like this one. This one's an easy one to remember. So under the entire contract provision, what this provision states inside the policy. Now, the other thing too I want to say is that there's no standard policies for life insurance. Well, what does that mean to you? That means that we can take 3 or 4 or 5 different policies, put them all side by side. Are they going to be the same or they're going to have their own variation? Same or own variation?
They're going to have their own.
Yeah, they're going to have their own variation. They're not going to be exactly the same. But there are common life insurance policy provisions that you'll find in all policies. And that's what we're going to cover. We're not going to cover every single policy provision that you might find in a contract, but we are going to cover the common policy provisions. And these are the definitions are also, these are the minimum requirements. And what that means is that, can the insurance company change the provision? Absolutely, as long as it's better for the client, as long as it's better. But these are commonly, they don't usually change these on the life insurance. So the entire contract provision states, it's pretty wordy definition, but I'm just going to give you the what you need to know, right? So the entire contract provision states that the policy, when attached to the application, makes up the entire contract. All right, so I know your cameras are off, but if you can indulge me for a moment and turn your cameras on if you're in a place to do that. Make a fist. And this is, again, a way to engage the body, right? To help you remember. So the fist is the policy. And I always think of like a scroll, right? So the policy. And then take a flat hand. The other hand is flat hand. And that's the application, right? So you've got the policy and the application. So we have these two things here. So we're going to take the policy and put it next to the application and wrap the application around. The policy, when attached to the application, make up the entire contract. It's that simple. Now, there might be some policy riders and other attachments made to it, but what is this? This is the
Policy,
when attached to the
application.
make up the entire contract. So since I have your cameras on, by raise of hands, how many of you have life insurance? Like you have individual life insurance policy? Only one person? 2 people. Okay, 3 people. 2 people have life insurance. Okay. Now, if you look at your individual, not your group policy, but if you look at your individual policy and you look at the contract, in the back of the policy, there is a photocopy of the application. And the 2 together make up the entire contract. See, the policy can't exist without the application, then the application doesn't provide you coverage unless you have the policy and the 2 are together. Now, and this is really important because there's another provision on this contract, in the contract, called the Incontestable clause. Anybody heard of that? The Incontestable clause? I think I mentioned it, Incontestable, on Wednesday, Incontestable clause. So everybody, what's the peace symbol? Peace symbol, right? Is this the peace symbol? 2? Okay. Now, what letter does that make? You guys are so quiet. V. So V, 2 years. Now, why is that important? Well, because it'll help you remember the incontestable clause. So just remember incontestable, peace, okay? So the incontestable clause prevents the insurer from using any misrepresentation or concealment against the insured after the policy is in effect. When policy has been in effect for how long?
2 years.
Thank you. Let me add to the definition, effect after 2 years. It prevents the insurer from, I mixed it up with 2 definitions, but it's the same because there's 2 different ways that you're going to see this on your exam. So this is 1, prevents the insurer from using any misrepresentation or concealment. You might see this as misstatements on your exam, misstatements against the insured after the policy has been in effect after 2 years. Another way to say the same definition, I'm going to use, let's use red on this one. The incontestable clause prevents the insurer from voiding, there's the V, right? From voiding, canceling, it means the same thing, or rescinding after the policy's been in effect for 2 years due to a material misrepresentation or concealment. I really messed up the definition. So, but like I said, there's two versions of it. That's why I messed it up. Because one way to say the same thing is what prevents the insurer from using any misstatements against the insured after the policy has been in effect for 2 years. They might not even have this part in there. They might just ask what prevents the insurer from using any misstatements against the insured and then end it right there. Or the alternate definition is prevents the insurer from voiding, canceling, or rescinding the policy after it's been in effect for 2 years due to a material misrepresentation or concealment. Now, what does material mean? I didn't even put that in here. What is material? Well, let me go back. What's misrepresentation? I'm going to close the door here because I can hear her out there. But I can still hear you. So who can tell me what's a misrepresentation?
A lie?
Yes, thank you. It's a lie. And what's concealment?
When you're like purposefully like hiding something, or maybe not purposefully, but you're hiding something.
You could be purposefully.
You could
hiding
be,
something.
but like, yeah, you're not giving the full truth.
Yeah, so it could be an intentional or unintentional withholding, right? And but the key to the withholding is withholding with the intent to deceive, right? With the intent to deceive. So like, all my highlights, hiding my gray, right? Withholding. So again, misrepresentation is pretty easy. It's a lie. And then concealment is just withholding information, right? Because this is recording, but I won't make this one public. I'm going to say this. I'm going to say it, go on a limb and say this, because I got to be careful with what I say these days. I'm a little bit nervous because people are so sensitive. But I like to say that men misrepresent or women conceal, because men don't know how to conceal. And they're not even really good at lying either. But, misrepresentation is lie. But women are really good at hiding things, aren't we? Like we can tell stories and like really avoid not telling what they want to know. But again, withholding, it's concealment is, what is it? Withholding the information. Just give me a second. It's so weird because being on Zoom, I'm only teaching like once a month now. And it's so spread apart. So I'm having a hard time remembering the definitions. I might have to get like a little cheat sheet for myself, but concealment is failure. This is what it is. Are you ready? I knew if I talked, it was going to come to me.
Like prevention.
Failure to tell the other party what they ought to know with the intent to deceive. That's the definition of concealment. So I'm going to say it. Actually, I'm going to write it out for you because it's part of the code in ethics. So it's failure to tell the other party what they ought to know with the intent to deceive. With the intent to deceive. Right. And check this out. If you take the word seal out of concealment, this will help you remember, I hope. Concealment, take the seal out of concealment. What do? What do they say? Right? No? Okay, you guys don't like that one? No? All right. Hey, I do my best to make these little associations to help you remember. So, but those are keywords that you can look for in concealment. And then misrepresentation is super easy, right? Because it's just a lie. You can't do too much with that. Now, is it important like that? This is the question, right? Because, okay, somebody lies, they lie. But is there different types of lying? Like, can somebody can it be a lie that's not important? The fact that I color my hair, is that an important lie? Is that a material misrepresentation or concealment?
No.
No. But if I go to a bar and sit next to a guy who's not wearing his wedding band and he's flirting and, is that a material misrepresentation? Concealment?
Yeah.
Yes.
Absolutely. The guy's married, right? So that's important enough to change the outcome. Now, let's take it back to insurance to help you remember this even more. If I fill out an application for life insurance and I had quadruple bypass surgery 5 months ago, is that material misrepresentation?
Yes.
Well, it depends. If I say no, I have no surgeries, no heart conditions, that's a misrepresentation. But if I don't disclose it, right? Because it might, if it's not within the time period, or maybe I don't disclose that I had a follow-up doctor visit and I'm withholding that information, then that's concealment. And so the reason I bring up that example is because I actually had a client who did that. I had a client, this was back in like 2001, fill out the application for life insurance and conveniently put no, because he thought it wasn't important. It had happened. I mean, his surgery, let's see, I took the application in May and then his surgery was in December. And so that was grounds for the company to deny the coverage. Like, they're like, we're not going to cover him. He lied. And not only did he lie, what else could he be lying about? So these are things that can actually affect the issuance of the policy, right? That's why it's so important that you tell the truth, because the company in the underwriting process is far more extensive than people realize. In the and this is worth me mentioning now, in the underwriting process, we defined this on Monday. What is the underwriting process? What is that? What is the company doing?
Writing the policy?
They're actually not writing it yet,
They're
Steph.
basically
They're-
evaluating you.
Yes, they're deciding whether or not they want to write the policy. So it's assessing, evaluating, that's what you said, right, Xavier? Evaluating and classifying the risk. And in life insurance, I mean, prior to like the internets, I say internets, that's so funny. And prior to like all of this techie stuff and all these data mining and Google and Yahoo and all that, I know one of our old textbooks from like the early 1990s had said that the number one collector of personal information was insurance companies. Now, this is prior to the whole tech thing going on, right? Because now they're like, they know everything about us. I mean, our phones are listening to us, everything's listening to us and trying to cater our online and plugged in experience. And so getting back to, well, if the insurance companies were number one collectors of personal information, what were they collecting back then? Well, this is what they were, and they're collecting still today, but just, it's not like as intrusive as what some of these tech companies are doing. So what the insurance companies want to know, and what's most important, right, is especially in life insurance, is that they're looking at your health. They're looking at anything that affects your mortality. And health conditions are the number one thing, right, that determines your mortality risk. So how do they gather that information? Well, one, you're going to fill out an application. And the application has 3 parts to it. Part 1 of the application is general information, right? They're going to ask you like your name, your phone number, your address, your social security number, what type of policy, who's your beneficiary, the amount of coverage, the type of coverage, all of that. The second part is what we call the non-medical questionnaire. Non-medical questionnaire. And the non-medical questionnaire is actually asking what? It's counterintuitive. Because if you think of a non-medical questionnaire, what do you think? They're not asking what? What are they not asking? You think that they're not asking medical questions, but it's counterintuitive because they are asking medical questions. Based on how you answer those medical questions, for example, have you been diagnosed? And then they'll list all these conditions, right? When was the last time you went to a doctor? Why did you go to the doctor? Have you had any gastrointestinal issues? Have you had any heart issues? Are you on any medications? They're gonna ask you all these medical questions. And if you say yes to any of those questions, they're gonna want more information. Does everybody get that? But if you say no, I'm not telling you to say no, but if you say, and as long as it's true, no, then they may not need any further medical information from you. Does that make sense? They might not do a medical exam. So a non-medical questionnaire may be used to determine whether or not further medical underwriting or a medical exam is necessary. What I just said, I'm not going to write it out. What I just said is something that you may see on the exam. It's like, it says something like, what is the purpose of the non-medical questionnaire? Or according to a non-medical questionnaire, which of the following is true? And what's true is that based on how they answer the questions will determine whether or not a medical exam is necessary. All right. And then number 3 is the agent's report. Now check it out. I gave you an explanation for non-medical questionnaire. The primary source of information to the underwriter is the application. They're looking at the insured's health plus what's another factor that affects your life expectancy? Your lifestyle. Smoking part of lifestyle? Because they're going to ask you that on the application. Now, they're not going to ask you about smoking because you could smoke anything nowadays, but they might ask you about tobacco use. Now, why tobacco use? Is tobacco high risk?
Yeah.
Mhm.
Yes.
Absolutely, it's the highest risk, right? But I always say, we got to stop shaming those people. If you're a smoker, then you know what? Good for you. Thank you for funding all of those medical and those state programs because they pay a pretty hefty tobacco tax. Did you guys know that? And the part of the tobacco tax goes towards education and it goes to like health stuff. And not only that, we're overpopulated. So, they have a higher mortality risk. So they're going to die sooner. So I just say thank you for smoking. They always give me a weird look like, why do you say that? And then I tell them, well, listen, we're overpopulated. So you're contributing to that problem, to a solution for that problem. And that's supposed to be funny, but I guess you guys don't think it's funny. All right, maybe I just have a morbid sense of humor. I'll have to stop with that. But it's true, but I'm not kidding. I really do tell them like, hey, thanks for smoking. I know people always, give you a hard time for it. And then I tell them why. And it makes them think though, at least I'm planting the seed to make them think, oh, I'm not going to live as long. No, you're not. So again, health and lifestyle are factors. So what are the other sources of information that the underwriter has access to? Because this isn't necessarily enough for underwriting. The degree of underwriting, like the extent of underwriting for a life insurance application is based on the risk to the insurance company. So if the client wants a high level of coverage, right, and they want they want a permanent policy versus a term, which is temporary, the underwriting is going to be more extensive. The company wants more information. So then I'm going to elaborate on this more, and then I'm going to add, well, what are the other sources of information that the underwriter has? What are the other sources? So other sources might include the MIB, Men in Black, which stands for the Medical Information Bureau, APS, which stands for the Attending Physician Statement. They might have, well, I'm just going to give you these two for now. The rest are in your study material. And the reason I'm bringing this up now is because I want to highlight another question. They may ask you something that goes like this. All of the following are part of the application except. So all of the following are part of the application except. So general information is part of it, non-medical questionnaire, and the agent's report. What is not part of the application, see, it's another source of underwriting information for the underwriter, but it's not part of the application, and that's the attending physician statement. The attending physician statement are your medical records, right? But see, other sources would include like a paramedical exam. What's a paramedical exam? What's a paramedical exam? How many?
Physical?
Well, a physical, not so much in like you're going to the doctor, but you have like EMS, and a lot of this is changing because of COVID, but we're just going to talk about pre-COVID. And what we're talking about is like EMSI, I think they're actually out of business, APS, Exam One. Those are organizations, those are companies that work directly with the life insurance companies or companies that issue life insurance policies. And what they do is they set up appointments and they go out and they meet your client. When you take a life insurance application, they're going to go out and they're going to do blood, urine, height, weight, right? That's how they know about tobacco. Oh God, I had this one application that I took, husband and wife, took an application from both. Guess what he puts? Non-smoker, right? And she's a non-smoker. Comes back, he gets tobacco rated. Oh my goodness, I wanted to leave. I was so uncomfortable. She got mad at him because she thought that he stopped quitting. And he had to fess up that, first he said that the exam was wrong. And then he finally confessed and said, no, it's right. So, I mean, we still took the application, but nowadays, the policy is issued as a tobacco rating, if you quit smoking for a year, then some companies will adjust the premium for you to go back. But again, the paramedical exam gives more information, and it also gives them like what's going on with you now, right? I mean, what's the best way to find out what's going on with your health other than getting blood, urine, and getting all of that tested? They'll test for HIV. Here's another note you want to make for your exam. HIV testing is everyone gets tested for HIV. However, when they test for HIV, they have to you have to give consent.
Mhm.
You have to give consent in order for them to test for HIV. If you don't give consent, then it's illegal for them to test you for that. There's a lot of disclosures that you have to give in the process. All right.
And if they don't want to give a consent on that test, then what happened to the application?
You tell me.
Refuse to take it?
It's part of the underwriting process. So if they're not going to take the HIV testing, then they won't be eligible for coverage.
Oh, okay.
Yeah. The company wants the opportunity to underwrite their risk, right? So they want to know your health situation, your lifestyle. Now, just because you're HIV positive doesn't necessarily mean that you're precluded from life insurance. I've been around since like 1996, and I was taught that if somebody wants insurance, even if they have a condition, if you're willing to find, if you look hard enough, you'll find it. And so I was challenged with this situation, actually 3 of them specifically. And it was the same for each one of them. They're in my class. They say, hey, can I take you to lunch? Just the 2 of us. Is that okay? And I'm like, yeah, I'm fine with that. And usually it's toward the end of the week. And then they find a place, it's quiet in the restaurant. And then they say, okay, this is between you and me, share. I said, yeah, but can I share your story? Because I get permission. And all 3 of them said yes, just don't disclose who they are. And it's been so long, it doesn't even matter now. I don't even remember who they are. And so same question. Can you find me HIV? Can you find me life insurance? I'm HIV infected. And the first time they asked, I'm like, oh my goodness, I really have to put my money where my mouth is. So I got to go find this thing. And so I did. And for all 3 of them, it was the same case. Nowadays, it's more common. As a matter of fact, the people who are HIV infected are lower risk because they take better care of themselves, right? But back then you could still find HIV, but it was expensive. You had to be under the age of 40. And T cells had to be below a certain level. And what was the other thing was, and if they were infected by a blood transfusion, they were automatically excluded. It had to be through other means. Kind of interesting, right? The underwriting guidelines for that.
Mm.
So again, but the question is, are you willing to pay for it? Because it can get expensive if you're one of those higher risk individuals. The guy who had the bypass surgery 5 months before I took the application, he lied. It was a blatant lie. He said, no, no, no. He didn't really forget. I mean, at some point he finally confessed and he said, hey, he had quadruple bypass surgery. He was scared and he realized he didn't have anything for his 3 kids. And he was a single dad. The mom left them. And so if he died, who was going to care for his children? Like, how were they going to be cared for? And so he felt, and that was enough to compel him to lie on the application. And then I told him, I said, if you would have just told me, we could have put you with a company, they would have insured you, that you would just pay a higher premium, right? But now that he lied, it just puts him makes him a moral hazard because of his dishonesty, right? Going back to what we talked about in chapter 1. All right, any questions about this so far? So we've talked about 2 policy provisions. We went in a little bit into chapter 2, which talked about underwriting. But there's probably like 3 or 4 questions in this underwriting section right here. I'm all like pointing as if you can see me. This segment right here is all underwriting. Below that, there's at least 1 definition of underwriting, the application, 2, other sources, 3. So there's like 3 questions there too. I like to add up the points because how many points do you need to pass?
Is it out of 160 again?
It's well, you might get 160, but they're only going to score on 150.
50.
Yeah.
You only need 90.
I know. Isn't that awesome? You only need 90 points. And this chapter is like 25 to 30, 35 points.
It
So
still feels like a lot of questions you have to get right when you say that.
well, one by one, right? Okay, so let's talk about the other policy provisions here. I kind of move this thing up so I can have access to that. There we go, to add a page. All right, so we talked about entire contract, incontestable clause. Let's move on to the grace period. The grace period. Now, I'm going to put some keywords. I'm going to give you the definition of a grace period first, and then I'm going to draw it out for you. So the grace period is the time. People always say, oh, it's 31 days. That's not the grace period. That's the number. If they ask you how many days is the grace period, then yes, it's 30, 31. But if they're asking you what is the grace period, then you need to know the definition that the grace period is the time after the due date. Time after the due date to pay the premium. while coverage remains in force. To pay the premium. What does that mean while coverage remains in force?
Is there,
Your coverage is still active.
They're still covered while coverage remains in force, meaning that even if they don't pay the premium after that due date, they're still going to be, if they die, the company will still pay while coverage remains in force. So I have, I have a independent, I think I shared this. I have an independent health insurance agency. I work with the individual and family plans. I'm going to transition and help people with Medicare supplements and all that. I'm in the process of doing that right now. Now, the reason I share that is because I've had this happen to my clients on the health insurance side. I've never seen this on the life insurance side, but on the health insurance side, it is definitely happened. So, you have your due date. Your premium is due on this date. Now, if your premium is unpaid during the grace period, then you're still covered, pardon me. So coverage remains. And this is the grace period, time after the due date. Now, if the premium continues unpaid during the grace period, and now you're at the end of the grace period and the premium is still unpaid, then the policy will lapse. The policy will lapse. I'm not going to tell you the days for the grace period for the health insurance because I don't want real world and test world to throw you off. But what I will tell you is that I had a client who was late, who missed his premium. He was in the hospital, thought he was having a heart attack. He had an anxiety attack, and the total bills was, I don't know, it was like $9,000. And so it was like right here in the grace period, just to give you a visual on it. He still did not pay the premium. He calls me after the policy now lapses over here. And I said, so, well, when did you end up in the hospital? And he says, oh, on this date. I said, oh, okay, well, let me call. I just want to call and make sure that it was paid. And sure enough, it was already paid, even though the policy lapsed, because he says, I didn't pay my premium. I ended up at the doctor. Now they're giving me a bill saying that my policy lapsed, but that I have to pay the premium. Well, of course you have to pay a premium. You have to pay, even though you were late and you missed the grace period, they paid a claim. So because they paid a claim, you still owe the premium for that time period. Does that make sense? Even though the policy lapsed back here. So again, coverage remains in force during the grace period. You're still going to be responsible for paying that premium. Now, if the policy lapses, and we're only talking about life insurance now, let's go back to life insurance. If the policy lapses, you have what's called a reinstatement period. Again, these are all outlined in the contract, right? So what does reinstatement mean? To get it back, right? To reinstate means to get it back.
No.
In the reinstatement, they give you 3 years. Now, check it out. I've seen contracts that give you 5-year reinstatement. What a reinstatement does, though, what's required it for you to reinstate, because you're going to get the same policy you had before, and that's important to know that. So, one, you've got to fill out an application. Why? Because that's how they know you want to reinstate the policy. What else do you have to do? What else do you have to do?
Pay the past due premium.
Yes, plus interest. Plus interest. And then the last thing is you have to show evidence of insurability. What does it mean to show evidence of insurability? You'll hear this, people call it EOI. This is your medical. You've got to show that remember we said that you buy insurance with your health and you pay with your premiums. So you got to pass the medical. You have to qualify medically. This is very different than the ACA. How many of you guys, I don't want to make this political because it's not, I'm just asking, how many of you guys watched the debate last night? Nobody?
I did.
Okay. And what was something that, so what's the thing that they asked about that
They're talking about the like COVID insurance topic of like, would they be covered or not?
what's it called? If they don't, they're asking about pre-existing conditions. This is a big deal. Pre-existing conditions is a really big deal. And they're not insurance people. They don't understand that by repealing the individual mandate, they can't support the including coverage for everybody, like not using pre-existing conditions against individuals. People get this mixed up a lot because when this conversation with the media is talking about insurance companies have to accept everybody, they cannot exclude people with pre-existing conditions, is COVID a pre-existing condition? That has nothing, when they have the conversation about health insurance, that has nothing to do with life insurance. Life insurance is still managing the risk from a mortality perspective, whereas health insurance is evaluating the risk from a morbidity perspective. We'll talk about that on Monday. So when we're looking at the mortality risk, we're not looking at pre-existing conditions. We're looking at mortality and how the pre-existing condition affects mortality, not morbidity. They're two different things. But the curve for both of them, for mortality and morbidity, is an upward curve. So for both, as we get older, the life insurance companies and health insurance companies will experience a higher risk with the clientele, with an aging clientele. When we get older, the risk is going to go up no matter whether we're looking at life insurance or health insurance. It doesn't matter. The risk goes up. Does that make sense? And so this has nothing to do with pre-existing conditions. They will evaluate and they will look at the risk. And if you do have a pre-existing condition that will affect your mortality, guess what? That can preclude you or rate you, meaning that they may charge you a higher premium because you pose to be a higher risk to the company. All right. So you do have to show evidence of insurability if you go into the reinstatement piece of it. Now I'm going to go back and talk about the grace period, because in life insurance, your whole life policy might have what's called an APL. And APL stands for everybody, you know, this industry, especially the health insurance, wait till we get to health insurance. They love their acronyms, right? So APL stands for the automatic premium loan. So when you have a policy that has cash value, does term have an automatic premium loan? Yes or no? 50-50 chance. Does term have an automatic premium loan?
No.
No, because term has no cash value,
Mhm.
right? So you'll generally find the automatic premium loan in a whole life policy. Now, some companies will have it where if your premium's not paid at the end of the grace period, when?
At
End
the
of
end
the
of
The
the
end of
grace
the grace
period.
period.
Thank you. At the end of the grace period, at the end of the grace period, the APL will kick in and it protects the policy from lapsing. And in some companies, if they don't automatically include it, then you just have to check a box. And I'm telling you, you should just check the box. If it's not automatic, just check the box, because what it does is, like, you know, life happens. If somebody misses, like the check doesn't go in time and then the premium payment comes out, or maybe an emergency came up and then so the monies weren't available for the premium to come out, this will protect the policy from lapsing. There's advantages and disadvantages. The advantages is the policy stays in force. The disadvantage is that if the client continues to rely on the cash value to pay the premium, eventually the cash value will start to deplete it. It may get depleted and there may be no cash value. And if there's no cash value, guess what? There's no more coverage. And so I always like to highlight that it's not just about selling the policy, but there's another part of servicing the policy. And I think you get a lot more of that in the PNC world. So the PNC mindset is, you know, I always make a joke about, you know, property and casualty is the dark side. It's high maintenance. You know, people might have multiple claims. And, you know, in 1997, I was in 3 car accidents in the matter of 6 months, right? So clearly, like, you know, high maintenance over here. But life insurance, you know what? One claim one time and they don't come back to complain. That was a joke, you guys. That was supposed to be funny. No? Okay. But again, you still have to service the contract, even if it's a life insurance policy or a health insurance policy. Like, I'm pretty lucky. What I love about the health insurance agency, and I mostly work with individual family plans, is that they're really low maintenance. I don't have too many people that need a lot of attention. And I know 2 people that are always late on their premium. All the time. And then all I have to do is text them, hey, and I think they know if it's from me that, oh, my premium's late, I better pay it. Because usually they'll pay it within a week after me sending them the text, which I'm pretty lucky about that. Sometimes you just have to keep calling them and they're just late all the time. But those 2 people are my own 2 problem children. Again, you don't just sell the policy, you service the policy. And so when the APL kicks in for the premium, you already know they're late because the APL doesn't kick in, like we said, until the end of the grace period. Just call them and remind them and find out, like, hey, you know what happened? Or they might, whatever, and just get that rectified. Because it is a loan. And inside of the policy, you have a policy loan provision, right? When it's a cash value policy. And, when you have a loan and you're borrowing money, there is an interest rate that you're paying for borrowing that money. And it's a very low interest rate in your whole life policy. But in the policy loan provision, not only does it outline what the interest rate and the loan rate is going to be, but it also outlines if the loan remains unpaid, what happens? If the loan remains unpaid upon the death of the insured, what happens?
They would detect that difference.
Yep. The insurer will deduct the loan amount plus interest. Oops, not death. Will deduct. Insurer will deduct loan plus interest from the death benefit. From the death benefit. So far, so good. This is a lot of information. I don't even know how we're doing on time. Oh, okay. Well, I better push it here a little bit more. Why would anybody want to reinstate their policy? For what purpose?
To keep like the same policy, like
Yeah, they're keeping the same policy, Stephanie. That's right. So let's say, I don't know how old Xavier is, but we're just going to say Xavier's 23. He buys the policy today.
That's how old I am.
So Xavier's 23 and, 10-year, he's 33 now and he misses a premium payment. And he didn't realize it because it's on the auto pay and he just thought it was coming out. He's reconciling his accounts at the end of the year and he realizes, oh my goodness, I missed my premium for the last 6 months. He wants to go back and reinstate. Well, a lot of times I get the question, well, why doesn't he just buy a new policy? Well, if he buys a new policy, they're going to rate him at the age 33 and he's older and he might not be as healthy as he was when he was 23. You are in pretty good health now, Xavier, right?
Yep.
Well, I hope so. You're still young. You're going to be the best health you are now than you are later. I can tell you that from personal experience. So again, he's just like Stephanie said, he's going to get the same policy reinstated. So that means that the premiums of the 23-year-old will remain the same. Because if you remember, life insurance policies use the level premium concept. So when he was 23, if he bought a whole life policy, that premium is going to stay the same. But if he buys a new policy at 33, guess what? He paid all the mortality and expenses for all these years. It doesn't make sense to restart and reboot. See, life insurance is not a short-term strategy. Life insurance is a long-term, it's your foundation, it's part of your financial plan. And I'm a very, very firm believer that everyone should have life insurance, even if it's a small policy, because if anything happens, at least it's there to protect the people you leave behind, and you can get a proper funeral or burial or cremation or whatever it is that you want, and you're not leaving that responsibility behind to the people that you love as far as what are they going to do with your remains and what are they going to do with you if something happens to you. And I know it sounds really morbid, and sometimes people come with the perspective like, well, I'm dead, why do I care? Well, because it's the memory and the legacy that you leave behind, that matters to some extent, right? Making your mark. You don't want to leave behind this responsibility to people to figure out what to do with you. Okay, any questions so far? No, I'm so tempted into pausing this and then re-recording, but I don't want to deal with all the button pushing. I have to just get better practice at that, but I'm not going to do that right now. So we're just going to go on to the next policy provision.
Did you, I'm sorry, Irma,
Yes,
it's
yeah.
Leah. Did you mention the how many days in the grace period? Did I miss that?
I said it, but I didn't write it down.
I'm sorry. How
No.
many-
31 days.
Oh, okay.
Yeah. All right. Let's go on to the next slide, the next provision. So the next provision is what's called the assignment, an assignment. And this is pretty cool. This is a very interesting feature that's included in the life insurance policy, in that an assignment, this provision allows the policy owner to transfer transfer a portion or all incidents of ownership to another party. So this basically gives you the right to sell your policy or give your policy to someone else. And sometimes it makes sense to do that, right? Like when you're young and you're first starting out, you might not have much, because we talked about the trajectory of, like, you learn and earn, and then you're on your income earning years. And then after income earning years, you're going into your distribution, your non-income earning years. This is your financial freedom, retirement stage, right? This whole area, the distribution phase. There's a whole industry in regards to distribution and estate planning. So when you're first starting, you might not have much. So you own the policy. So it might make sense to transfer all incidents of ownership. Once you start to accumulate your assets and you have more to protect, you might actually put your life insurance policy in a trust. Because you want to, as long as you don't own the policy or you're not the beneficiary of the policy, it stays out of the insured's estate for estate tax purposes. See, one of the benefits in life insurance is that it avoids probate, which is a very big deal because probate can take years. And the biggest benefit to your beneficiaries is that the death benefit is non-taxable. What's non-taxable? What's non-taxable? This is on your test. Actually, most of this that I talk about is on your test, the death benefit. Yeah.
Mhm.
So when the policy pays out, here's $1 million to your family. That makes a difference between 60 or 70 cents on the dollar, depending on your tax rate. That's a big deal. Would you rather keep $1 or 60 or 70 cents? Would you rather have the money now or have the money later? So it does two things. It provides the death benefit right away, and the beneficiaries get the entire benefit. They don't have to just do a part of it because of taxation. This is really sexy to have tax-free death benefit, right? Now, like I said, avoids probate. You want to keep it out of the estate if you have a sizable estate. Now, as it stands now, this is a moving target, but as it stands right now, and I don't know what's going to happen in the future, but I think the exemption, don't even quote me on it because I don't even remember what it is anymore. I used to keep track of it, but not anymore. I want to say it's like $14.5 or $9 million. Now, this has to do with the estate tax. What this means is that if your assets, after you die, they're going to look at what you owe, what you own. And if your assets are less than 14.9 million, there's no tax. However, if it's greater than, there is a 40% tax rate that has to be paid before your assets are distributed if it's for any amount above 14.9 million. See, 14.9 million is the exemption. So you can have up to 14.9 million and there's no estate tax. But anything above 14.9 million will be taxable at a tax rate of 40%. And your family has to pay that before the assets are distributed from your estate. Does that make sense? So if you have a multi-million-dollar policy in your, if you own it or you name your estate as the beneficiary, you can get yourself above that 14.9 million threshold if you're that close. Does that make sense? So a part of the advanced planning might be that a trust owns it. You bought it when you were young. Oh, look, you have you've accumulated all this. Let's take the policy out of my ownership and transfer all ownership to a trust. Now, that's one reason for the assignment, one use for the assignment. The other one, the one that you're likely to see on your test, has to do with a viatical settlement. Now, viaticals were used back, and they were really popular back in the 1980s. And I know it's so outdated, I don't even know why they're testing on it. But what happened is that this industry, back in the 1980s, if somebody was terminally ill or if they thought they were going to die, they would sell their policy to a viatical. And when they sold their policy to the viatical, they would get money now while they're still alive. This industry evolved into what we call today life settlements. And in the life settlement world, you have to be above a certain age, usually 70 or older. You're closer to dying. Or, well, you're not, the insured's closer to dying, age 70 or older. Or, you're terminally ill and you didn't qualify for the insurance company to advance the benefit. See, this was back in the 1980s. It wasn't until 1994 that the insurers introduced the accelerated death benefit. Words mean what they say. We talked about this on Wednesday. The accelerated death benefit allows for a portion of the death benefit to be paid when the insured is terminally ill, but they have to qualify. So if they don't qualify or meet the company's underwriting, the guidelines to get the accelerated death benefit, then the alternative to the policy owner would be to go to a life settlement company. Now, what's the question on the exam? I'm going to give you the question. Is that okay? Because there's the answer. Can I give that to you guys, or do I have to go? Do you want further explanation?
Give us the question.
Thank you. That's what I wanted to hear. So, excuse me, the assignment, transfer a portion or all incidents of ownership. When you transfer all incidents of ownership, that's an absolute assignment. We call that an absolute assignment. If it's a portion, we call that a temporary or collateral assignment. I'm not going to write that down. They may ask you something like this, under a viatical settlement, which of the following provisions allows for this to take place? So what allows for the viatical settlement to take place is the absolute assignment. So we always say V viatical, think of V vodka. Do we have any vodka drinkers? No, no
Mhm.
vodka.
Sure.
Yep.
Oh, who's the sure?
Stephanie, I mean, it depends on what kind of night you're trying to have. I don't know.
All right. Well, you're in San Jose, right, Stephanie?
No, I'm in the Tri-Valley.
Oh, you're up there.
Yeah.
I don't know of any places up there. I'd say we got to go drinking then. So I like vodka and cranberry. That's my favorite drink with peach schnapps.
I'm
It's like
down for that.
it's like juice. So so if you see V viatical for vodka, what kind of vodka? I prefer Tito's, but what kind of vodka? Absolute vodka. Absolute vodka. Or the I heard that the Costco brand is actually Grey Goose. Did you
Yeah,
guys hear?
Costco, like, all their alcohol is amazing and great.
Thank you, Stephanie.
You're welcome.
Well, Christmas is around the corner, you got it, the holidays and family.
Mhm.
Maybe a big Costco bottle of vodka might not be a bad thing.
Their pink lemonade vodka thing is really good, and it was only like $10.
Which, the pink lemonade?
It's like a pink lemonade mix thing that they
It's,
sell.
I
And
think
Oh.
it's Svedka, isn't it? Svedka
I don't know what it is,
like a
but-
pink lemonade vodka. It's really good.
it's really good, and one bottle to yourself will lead for some great memories.
I love you guys. It's awesome. Ooh, thank you. All right. So if you see viatical V for vodka, think of Absolute in Costco. All right. We've got one more to talk about, and that's the misstatement of age or sex. Not how often, just kidding. Okay, so misstatement. I'm definitely not going to post this one on YouTube. Misstatement of age. Now, this will supersede the incontestable clause. This is like specifically stated in the contract that this is how they will handle a misstatement of age or sex, right? Gender. Now, a misstatement of age this provision allows the insurer to adjust the death benefit according to premiums paid. Now this is a really big deal, according to premiums paid. To err is human, people make mistakes. When you take an application, you may not necessarily be the one who's putting it into the computer or the system. Numbers get transposed. I've been 39 for like the last 8 years. So I don't really know. I got to do the math to figure out my ages. So, I mean, it could be anything, right? And so if there's a misstatement or an error, the insurance company is going to adjust. And the question is, how do they adjust? This person is 25, and this is just an example. This person is 25 and they're charged a premium rate of, I did it backwards. This person is actually 30 and they should have been charged a premium rate of $10. But with the error, they were charged as a 25-year-old and they did pay $8. So what should they have paid? They should have paid the $10 for every $1,000 worth of coverage because they're talking about the premium rate. So should was 10, but what they did pay was 8. So how do they adjust? They're going to take the did, and this should be familiar to the P&C. I think Stephanie and Amanda are P&C. So the did over the should. What they did charge over what they should have charged times the face amount is how they will adjust. So this example, it would be 8 over 10 times the face amount. Now, if you're like a math person, you're going to say, well, what if I do the ages? Isn't it the same? That's not what they're calculating on. They're testing you to know that it's based on the premium rate. So what they did charge you in the premium rate, what they should have charged you times the face amount is going to adjust for what you should have paid. Now, the reverse is true as well. So if, let's say, I paid for a 30-year-old, but I should have paid as a 25-year-old, the numbers are just going to be 10 over 8, right? Times the face amount. So I'm going to get more. Well, not you, you're dead, but the beneficiaries will get more or they're going to get less according to how the adjustment works out because of the misstatement of age. Does that make sense? I always describe as this one. It's interesting because what happens is that you deliver the policy, because in life insurance, we deliver the policy. And policy delivery is so important in life insurance. Why is policy delivery so important? Oh, this is our last policy provision right here. The policy provision is so important because you have to get a receipt. Any receipt where the insured or the policy owner signs on the receipt. The reason why it's so important, because this begins the free look period. The free look period is also known as the right to cancel, right to rescind. It's all the same. It's all the same. And in life insurance, when you deliver the policy and you get that receipt, it gives the insured, the policy owner, a period of time to evaluate the policy, and they can return the policy for any reason. For what reason?
Any reason.
Did we do this one already? On Monday, did we do this one on this one? Did we cover free look? Return.
No.
Okay, we're gonna do the movements in a minute. Return the policy for any reason. And what will they get back?
Their premium paid.
They're gonna get all the premium paid back. They're gonna get a return of all premiums paid. For any reason, return all. How many days do you get? How many days do you get?
10?
10 to 30
Is it, yeah, I was
days.
supposed to say 10.
10 to 30 days. And if you're age 60, you're going to get 30 days. You get 10 to 30 days. If you're 60, you get 30 days.
30.
Yeah. Now, when that policy is delivered, you know what happens to that policy? It goes in the junk drawer. I mean, the important drawer where all the important documents go, right? And then people never look at it. So if they don't even see it until the time of death, it's really important that you review the policy before you deliver it, because if there's any errors, you're going to need to be able to catch that, right? Or hopefully the client catches it. But if it's not, then that policy does go in that important document drawer or in the junk drawer, and then it's never to be seen. And then at the time of claim, the death certificate is going to reflect the age and the date of birth, and then the date that they died, and then the company will reconcile against that documentation. And so, you just want to make sure that everything's accurate as a normal way of doing a normal business practice, just to ensure, just to scan, right? Now, you guys ready for the movement? So please turn your cameras on and we'll do this last movement, and then I'll send you off to lunch and we'll come back at 2:30. So this is the free look. So everybody go like this. Don't touch your face though, because this is, this is COVID days. So put your eyes, yeah, there we go. So this is the free look. So check it out. The free look allows the policy owner to return the policy for any reason. What reason?
Any
Any
Put your
reason.
hands up. 10 to 30 days. How many days?
10 to
10
30.
30.
10
10 to
and
30
30
days. Put
days.
your hands out in front of you. What do you get back if you cancel?
All your
Are you
All
premium?
the premium back. So I'm gonna do it one more time really quick. Ready to see get the movement into your body. So the free look period allows the policy owner to return the policy for any reason. What reason?
Any reason?
Any
And
reason.
how many days?
10 to
10
30.
to 30.
Thank you.
10,
And then what do you
30.
get back?
All your
Or the
premium.
premium.
all the premium. Now, the exception to that is it's not an exception. We're gonna get to the exception in a minute. For seniors, we want to remember that they get more time. The senior gets 30 days if they're 60 years or older. So they've got to be age 60 or older, they get the 30 days. Now, I want to say the exception is for variable contracts. Now, we didn't talk about that in the previous segment, so I'm going to talk about that, and then I'm going to send you to lunch because this says I have 2 minutes, that says I have 5 minutes. So real quickly, the variable contracts, anytime you see the word variable, these are keywords. You're going to look for a separate account. And are you down with SEC? Yeah, you know me, right? Because the SEC, FINRA, and the California Department of Insurance regulate these products. So if you're going to sell a variable life insurance product or variable annuity, you have to get an additional license to sell those products because these products are tied to the stock market. These are tied to to equities, they're tied to mutual funds. And so as you know, there's a lot of volatility that goes on in the stock market. And we've seen a ton, I mean, the stock market has been on an upward trend. It's been in a bullish market for a really long time. And but you do get a difference. You do get a lot of intraday trading in the last few months, depending on where you were investing. I mean, a lot of the tech companies were on an upward tick and they're doing really well. But some of the other companies might not be doing as well because of the whole coronavirus thing. But I just wanted to let you know that when you tie the insurance product to something that is linked to the stock market, there's risk. And we talked about this on the first day, right? There's an inherent risk when you invest your money in the stock market. And so with that being said, if there's a cancellation, so there's a disclosure on the variable contracts, and the disclosure is this: the default, if it is not designated, the default, this is the automatic. The automatic is during the free look. During free look, those monies are not invested. The monies go into money market and fixed accounts. These are keywords for all of this, okay? So you got to remember this. So money market and fixed accounts. No risk. If they cancel, right? When they cancel, like I want to cancel my policy, we're going to make this as simple as cancellation. Then you're going to get all your premium back. So they're going to return premium paid. You're going to get back the premium paid. However, let's say, Stephanie's I have investment experience, Irma, and I want to make sure that my monies are invested right away. This free look thing so again, the insured directs, the direction is immediately invest. So Stephanie says immediately invest. Where does the money go? It's going to go into the mutual funds that she chose. The policy owner chooses the mutual funds in which the premiums are invested. So then who assumes the risk there? She does. The insured assumes the risk. And what happens is if they cancel during the free look, she's going to be subject to the volatility, meaning that she buys the policy and the premiums get invested here. But she decides to cancel right here. Actually, I don't want to do that. She decides to cancel. Let's change it. She decides to cancel here. Oh, we'll use both as an example. So she cancels. What will she get back?
Account.
She's going to get the value of the account. She's going to get the account value back. So if she cancels here, she's all like, woo, I made some money, just a little bit. If she cancels down here, she says, oh, maybe I should keep it, right? But she's got to cancel within her free look. And this is true for whether you have a variable product or a fixed product, it doesn't matter. If you cancel outside of the free look period, you're going to be subject to what we call surrender charges. What are you subject to?
Surrender
Surrender
charges.
charges.
Yeah, so you're going to be subject to surrender charges if you cancel outside of what period?
Free look.
The free look, yeah. So subject to surrender charges if canceled after free look. Isn't this a fun? Yay, no, just me, okay. All right, well, it's 12 o'clock. It's break time. So we know how we close it, right? So go ahead and put yourself in a seated, comfortable position. Inhale your hands up high to the sky, reaching for the stars. Nice big stretch, excuse me. Exhale, go this way. Inhale back up. Exhale, go the other way. Nice stretch there. Inhale back up to the top. Exhale, your hands out in front of you. And let's lock it in for easy access at any time. Ready? 1, 2, 3. Awesome. So see you all at 2:30. What time?
2:30.
30.
2:30.
you.
All right. You're welcome. Have a good lunch. Have a good break.
Thanks.
Bye. You're welcome.